For me, my assumption that I make is that you build a policy assuming inflation and currency risk is real.
I mean, the other thing is that, we did have higher levels of debt. Most countries had debt to GDP of...
Really? They're just getting on that? So if you assume that currency and inflation risk are real?
This is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it.
What if everything you've been told about the US economy, the strong GDP, the stable dollar, the so-called recovery, was just an illusion? In this powerful new conversation, Andy Schectman and Alasdair Macleod uncover the truth behind America's financial strength, and why the next phase could change everyone's future. From the hidden cracks in the US dollar to gold and silver's quiet rise, they reveal how history is repeating itself, and what it really means for your money, your savings, and your stability. Stay tuned, because by the end of this video, you'll see the economy in a way you never have before. So let's start with Alasdair, and then hear what Andy Schectman has to say about it.
I think part of the answer to that is that if you look at the level of debt in the United States, I mean, the US government's debt, is about 115% of GDP. The ability to pay that comes out of the private sector, the taxes, if you like, that the financial and non-financial sector provide to the government. That's the important thing. Now, if the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. And that basically is what we're seeing. I mean, I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, I mean, it sort of goes along like that, and then, it's done that. That, if you like, is really what's happening with the debt trap. And that's why this can't be muddled through anymore. This is coming to an end. I mean, it's actually as simple as that. You need to look at the whole thing in the round. The idea that we can continue to run high levels of debt. I mean, the other thing is that, we did have higher levels of debt. Most countries had debt to GDP of 160, 180, 200% at the end of the Second World War. But the difference then was that we were on the Bretton Woods gold standard. And that kept interest rates down, and it allowed for the expansion of credit, which was angled at production more than anything else. So it was inherently non-inflationary. So what you had was the ability to do yield curve control. That was the time of yield curve control. And you could also persuade investing institutions to act in a certain way. There was all this sort of, if you like, off-the-record briefing of institutions. So, but that cannot happen now. It just does not happen. You cannot have yield curve control. You cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave, that doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies.
From precious metal standpoint, and I can speak to the larger economy after, but you can't keep suppressing a market when the world is pushing back against you. The only way to do so is to push it in the direction that it is going. And as I've said on your show for 5 years now, that the biggest money in the world is wise to suppressing. When you see 8 Western banks holding the largest concentrated short position on 1,000 commodities traded on the COMEX, and that being in silver for years in a row, it's not too hard to see it if you look. that it is certainly a collusion of the West for reasons. And you could argue gold for Gibson's paradox, the inverse relationship between real interest rates and the price of gold. And I would argue silver for the military-industrial complex, the need to make high-tech weapons, the need for massive amounts of silver to do so. And we've talked about that ad nauseum. I don't need to go into that, but the world is wise to us. And this is why you see coordination between countries that are sophisticated and motivated and wealthy now and understand what we're doing and using it against us by standing for delivery. In fact, probably shorting it themselves to do so. That's why China, the largest producer of gold and second largest producer of silver in the world, are actually taking the time to fly to Latin America to buy gold and silver directly from the miners, like Sean Kun, Dolly Varden, who told me this, and paying double what the West will, and sending it back for refining when they're already producing more than anyone in the world. Why would they do that if it means nothing? They see the big picture. That will end. And in terms of the way that the sequence goes on the bigger picture, we're seeing inflation spiking, I think. I mean, they're giving up to it. It's at 3%. It's much higher, which we said it's 11, really, if you ask John Williams. And they're going to pour more gasoline on the fire right now, even though they're 50% away from their target. To Alasdair's point, this would lead to bond losses. To Alasdair's point, again, this would lead to central banks panicking, doing yield curve control, suppressing interest rates, which leads to currency declines. And if the currency is declining already in a period of time where no one trusts the institutions and the markets really anymore, because we have weaponized the treasury against countries like Iran and Russia, yet we've been in Iraq for 22 years under false pretenses, destroyed their country, toppled their regime, and we're still there occupying their country. How is that fair? Now, I'm not making any judgment on Iraq or on the Ukraine or Russia war, but how is it that we can tell Russia, well, you know what, we're going to take your treasuries that you have stored with us and we're going to confiscate it, in essence, default on them, and we're going to give it to, largely in the form of weapons, to the Ukraine. And that's okay, but we go into Iraq for faulty reasons, and we're still there 22 years later, and we've just decimated the country. So when you talk about trust, there is none any longer. We are not trusted. That's why U.S. Treasury holdings are down to their lowest level ever, like 39% across the board. And so as it goes from inflation to bond losses, to the panic of yield curve control or suppression of interest rates, to your currency declining, along with no trust, you get a flight to hard assets. And isn't that what we're seeing right now with the acquiescence of the big commercial banks to tell their institutional clients, you better get 20% of your assets in gold now? And I think people and institutions need to front run that sequence, period. And it's really not hard to see that. I think, for me, my assumption that I make is that you build a policy assuming inflation and currency risk is real. And we've lived, this is a problem, all of us in the West have lived in a world where bonds were risk-free. They're not. And that currency was permanent. It's not. Right? My father, first year out of college, married my mother, and $6,000 a year starting salary at Helene Curtis Cosmetic Company way back when was enough for him and my mom to live comfortably on $500 a month, comfortably, in 1963. And I said, there's no way, Dad. Yeah, look it up. The average salary was 10 grand that year, 9 or 10 grand. So out of college, first job, okay. All of this stuff is not permanent. And this was during a time when the United States and London, UK, were revered, were thought of as the bastions of honesty and integrity and free market enterprise, and they're not. And now we have policy that is coming in that is frightening the world through sanctions and tariffs masquerading as tariffs that are actually sanctions, and fiscal irresponsibility to the nth degree, where we create $1 trillion of debt in 71 days, right? $1 trillion sections ago was 31,688 years ago. We can create a trillion of debt in 71 days. And we bring on a company or a group like Doge, who finds $2 trillion in things that could be cut, but Congress can't agree to more than $200 billion. That's about 38 hours of spending by the U.S. government. So if you assume that inflation and currency debasement, what are they calling it right now? The debasement trade. Oh, really? They're just getting on that? So if you assume that currency and inflation risk are real, and that bonds are not risk-free, and that the dollars you hold are not permanent, in fact, they act more like a melting ice cube, then you'll be better off and understand the reasons to hold gold and silver, not to become wealthy. You might if you own enough, but because it is wealth, that the smartest money in the world is telling you through their actions they agree. The most well-informed money in the world is telling you they agree. Take it for what it is. Don't take my advice. Look at what the big money is doing, and you'll see that they're leaving the equity markets and they're moving to tangible commodities in their own possession. And that is the truth.
As Andy Schectman and Alasdair Macleod explained, the signs are all there. The cracks in the dollar, the shift toward real assets, and the growing demand for gold and silver. The question now isn't if change is coming. It's how ready you are when it does. If you found this discussion valuable, don't forget to hit the like button, subscribe to the channel, and turn on the bell icon, so you never miss another powerful insight on gold, silver, and the global economy. Stay aware, stay prepared, and we'll see you in the next video.